Is this microphone on? Am I being recorded? Hi, I'm Dean Jenkins with FollowMeTrades.com, and it's Saturday, October 8th, and this is the market update for the week coming up of October 10th. You know, with so many examples of people aspiring to high office being caught with a hot microphone saying things that they really don't want repeated, you think that would be the first thing that somebody would check if there's a microphone in the room and would say, is this microphone on? And I like to link current events to what's going on in the market. I think it makes it interesting and provides a backdrop. Of course, the presidential election is a big deal, and I think the market probably is going to be waiting and continue to consolidate just a little bit until after the election. But if we were to humanize the market, to anthropomorphize it, what would the market not want to be caught saying into a hot mic? And I think the answer would be, I'm overvalued. There's nothing to support these current price levels. Let's take a look at a higher time frame real quick. So here's a weekly chart of the S&P 500, and I've pointed this out for several months now. We've been in a bull market for 7.5 years, and it's gone almost straight up, and now we've got a period this year of some consolidation, a little bit of volatility, and then some new highs. As I said last week, the price to earnings ratio for the S&P 500 is 25.08, which is enormously above the historical mean of about 15.25. So the market is, at least from a historical basis, overvalued, and it's been in this long run, and it is due just for a normal, healthy, cyclical correction down to these Fibonacci levels between 38.2 to 61.8 Fibonacci levels, which would take us down to 1674 to 1385. Now, it hasn't started yet. There's no proof from any technical analysis that it has started yet, but we can just sit here and look at this chart and expect that at some time in the near future it would begin. Now we could, as I've said, go out and eke in some new highs. I think we're going to stay definitely below 2250. But let's drill back down to the daily chart and look at some interesting patterns and what's going on right now. So this is the daily chart of the S&P 500. You can see late September we had a couple dramatic days, and then it's really consolidated and it's trading in a fairly tight range. And there's some interesting patterns here. I'm going to take my indicators off for just a minute and just draw a pattern. Before I do, these purple lines, I put these on here last week. I've got a high at 2179.99. I got a comment on my video. So someone said, just say 2180. Okay, so 2180 and 2119. This is a channel that the market is currently in, and I think whichever way it breaks out of this channel will be the direction it takes, at least for the intermediate or short term. But it is stuck in this channel. Now let's drill down and look at an interesting pattern. So this is the S&P 500 daily chart, and I've just zoomed in. I've taken my indicators off, and I just want to look at these last couple weeks of price pattern, because there's a formation here that is really important. So I'm going to draw it. So this formation is what is known as a pennant, and I'll draw these lines from here to here, and then from here to here, like this. So that's a pennant. You know, it looks kind of like a flag, or you could a wedge is another term for it. Wedges can go up or down, but this is a pennant that's extending to the right. And you can see that what this is showing us is that the movement of price is the support and resistance lines are narrowing, and so it's moving into a very tight range. Now price will break out of that pennant at some point. It may go for a few days and continue to narrow, but at some point it will break out, and when it does break out, it typically breaks out with some volatility, whichever direction it goes. So when it breaks out, it'll probably break through one of these purple channel lines that I have marked here, and we'll know the direction the market's going to go, at least in the intermediate term. Now it could stay, you know, in a narrow range up through the election, which is about a month away, or it could break out before then. Now we're just going into earnings season. Typically, you know, there's some companies that are already reporting. Typically the official start is when Alcoa reports, which is on Tuesday the 11th, this coming week. But already the market has shown that it is very sensitive to earnings and to any hint of bad news, and this is where you want to be careful about whether the microphone's on or not, and whether it's being recorded and just, you know, what what uh, what you want to be said for the record. There's a couple of companies that updated their forecast last week, and they got hammered. So this is Honeywell, and on Friday they upgraded or downgraded rather their forecast, and they're down 7.5%. And PPG, same thing, lowered their forecast, and they're down 6%. Pretty big gap down. So the companies that are reporting earnings, I think there's high expectation up here at this very high valuation level, and even not growing, staying flat is going to be viewed as bad news. And so we could see the big kickoff of earnings, with Alcoa and some other big players, Delta Airlines, Bank of America, several companies reporting next week, that earnings could be a trigger that would then break us out of this current wedge that we're in, and ultimately out of this channel that we're in, and set the direction for the market. So we got to watch that really, really close. We'll continue to provide updates on that, and as it plays out, I look forward to seeing what happens. Again, when we looked at the higher time frame, we are due for a fairly substantial correction, normal and healthy. It could be the presidential election, regardless of who's elected. That just coincides with that market cycle. So again, no evidence of it starting yet, but we are in anticipation of it. We're prepared to trade. When it goes down, there's going to be some really, really good trades. The market goes down faster and more dramatically than it goes up, and so there will be some great trading opportunities there. I am still going long in certain sectors. Energy sector, for example, I'm long in, and there's some really good upside there. But in terms of stocks that are part of the broad equity indexes, I'm already short on some that are heading down, and looking for more when this correction finally does get underway. Let's close out by taking a look at gold and oil, as we do each week. So we've been saying for several weeks now that we thought that a top was put in on gold back here in July. We traded this leg up and this leg up here earlier this year and did really, really well on it. And that was a Elliott five-way sequence. That was 3, 4, and 5. And we said, hey, it looks like it's over. All the technical signs here that it would be heading down and channeling. Well, it's heading down for sure, and it's probably not over yet. I don't think gold's gonna correct really deeply beyond this. It may drift down, it may channel and go sideways from here. That's really what the analysis is showing, but certainly no longs on gold at this time. Now, once the equity market correction does start, later this year and the next year, there may be a turnaround and some great trades in gold. We'll be watching that really closely, but for now, we're not in gold, and not long or short. And we think, again, that big run is over. Well, oil's doing awesome. We had defined last week a channel that oil had been in the short term, and that it needed to break up out of for the next leg of the recovery in oil to be underway. And look, it broke out of there with some gusto. Absolutely. So this was a great leg of oil. We traded this. We had a pretty sharp pullback this summer, a little rally, another pullback. But this is really, if we look at Dow theory, from here a high, higher low, new high. And that's what we were looking for, to come out of this channel, to actually take out this high. Now it's taken out this one. So this is clear evidence that the next leg of oil heading up, probably going to take out these highs. It could get up into the 60s. When we look at a longer term time frame, this is all still a wave 4. We had a big wave 3 down. This is a wave 4 correction up to this massive impulsive move down. So we could get up over 60 on oil. From a technical standpoint, fundamentalists would shake their head and say you're insane, but based on the technicals here, it's definitely possible. And the fundamentalist wouldn't have had it going to 55 earlier this year either. So we'll just have to see. But we're getting along on some oil-related stuff right now, and it looks like it's underway. Now, don't be surprised if it pulls back. Price doesn't move in straight lines. It'll go higher high, higher low, new high, higher low. That's how price moves. So don't be faked out. It has shown that the recovery is really, the next leg of the recovery really is getting started. The oscillators gaining bullish momentum, bullish divergence. We're well above the Ichimoku cloud. It's rising. It's showing an uptrend. We've broken out of the channel. We've taken out previous highs. Against the bigger backdrop, this is a corrective wave to the massive down move over the last couple of years. So looking really good on oil. Well, that's it for this week. Earnings are probably the big deal coming up, and then of course the election, and it'll be really interesting to see how things play out in the markets. The reality of price movement. We look beyond the noise of the headlines and look at what is going on the charts. How is the market responding to all the information that's coming at it? And that's ultimately reality, and that's what we trade based on. Catch you next week, and thanks.